Welcome to the recap of last week's data releases and related developments. The week started with the release of Chicago Fed National Activity Index. CFNI decreased to -0.05 in October from +0.17 in September, indicating weakening economic activity amid high inflation and rising interest rates. As you can see from the graph, 3 of the 4 broad categories of indicators used to construct the index made negative contributions in October, and 3 categories deteriorated from September.
The sentiment was further reinforced by Richmond Fed Manufacturing Index, which remained negative but edged up from -10 in October to -9 in November. Of its 3 component indexes, the indexes for shipments and employment deteriorated slightly, edging downward to -8 and -1, respectively. The third component index, volume of new orders, however, showed some improvement, increasing from -22 to -14 in November. The wage index decreased notably from 34 to 25 in November but remained elevated. The average growth rate of prices paid decreased in November, while the average growth rate of prices received increased somewhat.
Mortgage Bankers Association released its weekly mortgage applications survey for the week ending November 18. The Market Composite Index, a measure of mortgage loan application volume, increased 2.2% on a seasonally adjusted basis from 1 week earlier. The 30-year fixed-rate mortgage fell for the second week in a row to 6.67% and is now down almost 50 basis points from the recent peak of 7.16% 1 month ago. This should improve the sentiment for prospective home buyers. Further, with the decline in rates, the refinance share of mortgage activity increased and so did share of adjustable-rate mortgage applications.
The positive mood from the MBA data was short-lived as S&P Global came out with its latest flash PMI data that reflected a solid contraction in business activity in November. The headline flash US PMI Composite Output Index registered 46.3 in November, down from 48.2 at the start of the fourth quarter. The rate of contraction signaled was the sharpest since August and among the quickest since 2009. Lower output was seen across both manufacturing and service sectors amid increasingly steep downturns in demand. However, there were some green shoots in form of housing sales and consumer sentiment turning out to be better than expected. Sales of new U.S. single-family homes unexpectedly jumped in October, despite rising mortgage rates. New home sales increased by 7.5% to a seasonally adjusted annual rate of 632,000 units last month. The median sales price of a new house was $493,000 in October, which was an increase of 15.4% as compared to same period last year. On to the consumer sentiment now. According to University of Michigan's latest consumer survey, consumer sentiment in November fell from the month prior, but came in stronger than the expected levels. The reading was 56.8 in November, versus approximately 55 forecast and 59.9 in October. Inflation expectations in November changed slightly from the month prior. 12-month inflation forecast dropped marginally to 4.9% as compared to 5% in October. 5-year inflation forecast increased marginally to 3% as compared to 2.9% in October.
In the week ending November 19, the advance figure for seasonally adjusted initial jobless claims was 240,000, an increase of 17,000 from the previous week's revised level. The 4-week moving average also saw an increase of 5,500 from the previous week's revised average. While job cuts remain low by historic levels, that may change to some extent with the tech companies going full throttle on cost-cutting and laying off employees. The scenario may get further aggravated with Federal Reserve's resolve to control inflation by opting for more interest rate hikes. At the same time, durable goods orders in October rose by 1%, versus 0.4% estimates, and much higher than September's 0.3% figure. Excluding transportation, new orders increased 0.5%. Last and most important of all was minutes of FOMC meeting. The comments were pretty much as expected insofar as related to the recent committee action. The participants seemed to agree that ongoing increase of rates was imperative to help keep longer-term inflation expectations well anchored. However, when it came to prospective rate hikes, then the thought process seemed to have undergone a shift. On one hand, the committee might look to slow down the quantum of rate hikes, but on the other might consider raising the target range of federal funds rate. Now that is a significant shift. This might imply a lack of confidence as to what is the upper range, 4.5% or 4.75% or 5%? The last 2 years have been unprecedented in every manner. Guess we will only get to know with time the level at which the Fed decides to stop. We will leave you with the effect of the aforementioned data points on the yield curve, dollar index and on the stock market indices. Hope you all had a good Thanksgiving weekend.